The data's good and the earnings are just fine, and futures are higher this morning with 30 minutes until the start of trading. I'm Sonali Basak.
And I'm Romaine Bostick. Matt Miller and Katie Greifeld, for some reason, are both off. Don't worry, Bloomberg Open Interest, it still starts right now.
And coming up, retail sales sizzle as Americans keep spending. And Netflix is going to take the earnings spotlight after the bell, a lot riding on the company's outlook for the months ahead. And a multi-billion-dollar deal. Uber is teaming up with Lucid and Euro to launch a Robotaxi fleet. But Romaine, first we have some stocks to watch before the market opens.
Yeah, keep an eye on the chip stocks. TSMC, the big contract chip maker, hiking its annual outlook on strong AI demand, and that is boosting tech stocks across the space. Just one day after its key trading partner, ASML, actually said that it may not grow at all in 2026, Sonali.
Yeah, I'm also watching United Airlines here as well. We're watching all the airlines, but United is up now 3.3% pre-market. It's been fluctuating. It narrowed its profit range for the year, but it gave a profit range. Travel demand is poised to rebound as Americans keep spending. Now, CEO Scott Kirby joined Bloomberg in the last hour. Take a listen.
This year, a lot of uncertainty in the first half of the year, macro uncertainty, and that led to an impact on bookings and demand at United and across the whole industry. But it felt like there was a turning point at the end of June where the tax bill passed and the situation in the Middle East was calmer, and tariffs, while not certain yet, narrowing the range. And it really felt like people felt enough confidence or enough lower level of uncertainty that they kind of came off the sidelines and were unfrozen.
Scott Kirby, the UAL CEO, speaking just a few moments ago. Joining us right now in Studio 2 is Bloomberg's global aviation correspondent, Sid Phillip, and some relatively bullish comments out of that interview. When you look at UAL's earnings, you look at DAL earnings a few days ago here, is it blue skies ahead?
It's still challenging times. I mean, it's early days, and the airlines are saying that they just saw a turnaround in terms of demand sort of coming back at the end of June, early July. So we still have a little bit of the summer left, and then we go into the sort of slump season when people typically don't fly as much. So we have to see how it all plays out in the run-up to the second half of the year and beyond. Because at the moment, there's still some uncertainty. I mean, Delta talked about it last week when they said that the back of the plane, the main cabin, economy cabin, is still hard to fill, while the premium cabin and long-haul travel is still holding up. So it's still early days.
Well, that was exactly what I was going to ask about, that bifurcation in the type of customer that these airlines have right now. Are we seeing a strong follow-through about worries about consumers that are not at the highest end?
There is, and I mean, that also sort of plays out into the whole low-cost carriers versus the regular full-service carriers, because a lot of carriers are seeing a sort of slump at the bottom end where there is more economic uncertainty, whereas for travelers at the higher end, they still have some spending power in terms of being able to spend.
Sid, we thank you for joining us here on set. That is Bloomberg, Sid Phillip. We're going to go back to that tech news that lifted the NASDAQ this morning that Romaine was just talking about. TSMC raising its outlook for 2025. Revenue growth to about 30% as demand for AI products showed no sign of slowing down. Bloomberg Tech co-host Ed Ludlow joins us now. Good morning, Ed. When you look at the comparison between what TSMC was saying relative to ASML, how do you parse through the noise of the differing outlooks from these companies?
Yeah, probably near-term sort of instant demand for products versus longer-term, right? When you build new capacity for semiconductor manufacturing, it's a multi-year process. TSMC is telling us that in the here and now, demand is really strong, right? AI demand is still hot, is what they said. And what's so interesting is this is a company now where 60% of revenues in that period are for high-performance compute chips that go into data centers. And it's increasingly pulling away from the smartphone market, which is also growing. But, you know, they kind of were like, we're a bit cautious. We're upgrading our growth forecast for revenue this year to 30%. It is cautious. That's the commentary because of tariffs. But it just shows that presently in the current calendar year, fiscal year, whichever way you want to put it, the buyers of those chips are committed to doing it. Whereas with ASML 24 hours ago, those that are building out additional capacity, maybe they are showing more immediate caution to commit to those capital expenditure projects. Although TSMC is the biggest customer, right? That's the irony here. And they maintain that capital expenditures commitment for this year, which give the market a lot of confidence. And I think you saw ASML shares react positively too.
Yeah, you're definitely seeing a lot of shares across that space react positively to this here in the pre-market. Ed, you're also seeing a bit of action right now in shares of Netflix, up about 0.6% in the pre-market as we await their earnings report. In the post-market, I know I'm not supposed to pay attention, Ed, at all to subscriber growth anymore, so I'm going to ignore that. Just margins, advertising. Tell me what to expect.
Yeah, I mean, Netflix has kind of been stamping their feet about this idea that they should be judged on normal financial metrics and that they want to be looked at on a bottom line basis, which is why we'll ignore them and we'll say, OK, if you won't give us subscriber growth, what does the content slate look like in the second half of this year? We know now that in this kind of streaming battle where subscriber growth goes in any direction or they won't give us the data, you kind of want some evidence that there's something worth tuning in for. And so like maybe on the close later today when the numbers post, will it be asking, well, Romain, is that something that you plan to watch or not? That might be a better metric to judge by.
I only watch 2 shows, Ed. The Close and Bloomberg
The
Tech.
only
Ed Ludlow, the co-host of Bloomberg Tech. And on Open Interest, at least for today, as we keep the show going. My apologies to Sonali there as we keep the show going here and focus in on the other big story this morning. And that was that surprise retail sales report coming in hot for the month of June, topping estimates pretty much across the board. Michael McKee joins us right now, our international economics and policy correspondent. Mike, you have a very stern look in your face, but when I looked at the numbers out of that retail sales report, it put a smile on mine. It seems like, at least for right now, we're still spending.
Well, if you think you're smiling, Romain, imagine what the president's face looked like at 8:30 this morning. We didn't see much of an indication of tariff impacts, although some of the categories that are tariffed did come in a bit low. But overall, headline retail sales up 0.6%, driven in part by stronger than expected motor vehicle sales. They were up 1.2%. And retail control, the part that goes into the GDP, was up a strong 0.5% after 0.1% gain the prior month. What moved? Well, we mentioned motor vehicles. Miscellaneous store retailers were up 1.8%, and then clothing and building materials were up 0.9% each. Clothing a bit of a surprise because obviously that's on the tariff lift. And then after the retail sales numbers, we got jobless claims down for the week, and that is also a bit of a surprise because these are times when the auto companies are shutting down to retool their plants, and usually we see a jump in jobless claims. The one bad news thing out of the numbers this morning, the Philadelphia Fed, while the headline number rose, prices paid jumped from 41 to 58.8, which is a sign that maybe there are some inflation pressures on the horizon. But again, any problems with retail, with consumers, or with inflation remain on the horizon. So I would imagine that sometime this morning, not too long from now, you will see a tweet that says something about a certain person in Washington being too late.
Great segue, Mike, because I was going to ask you about the latest chapter of President Trump versus Fed Chair Powell. I want to read you this note from the team over at TD Securities saying that they view this as a low probability but high impact event. And the impact being this, they say. They say that we would expect investors to price in higher long-run inflation, higher term premium, more near-term Fed rate cuts, and hence lower front-end rates, increased market volatility, and a steeper yield curve. How does that compare to consensus, what you're hearing out there in terms of how traders are viewing this as a market event, whether he stays or goes?
Well, that is pretty much the consensus, and we did see it play out that way yesterday morning when the first headlines came out that the president might be ready to fire Jay Powell now. We saw spreads widen, we saw the front end drop, we saw the back end steepen, and that would suggest that that's the kind of reaction we're going to get, perhaps even more extreme if the president does move. However, I think the TD people have it right. This is a low probability event because if the president were to fire Jay Powell, the Fed's going to go to court, and this could drag on for months, and Powell's only got months left in his term, so there's not a whole lot of benefit to the president, and there's a high risk for him that the markets could go haywire.
Mike, we appreciate your time this morning. That is Bloomberg's Michael McKee. And catch his exclusive with San Francisco Fed President Mary Daly today at 12:30 p.m. New York time. I'm sure a lot of this is going to come up. And it's interesting. A check on futures here. You are still seeing them higher. You did see yields higher this morning as well, but you are seeing them starting to cool off, Romain, a little bit on the front end of the curve. S&P futures, though, still up 0.2%. The NASDAQ 100, as you're talking about, 0.3% higher.
Absolutely. You talk about some of the individual movers out there. We're keeping an eye on Abbott. Abbott Labs, the forecast actually missing estimates as diagnostic sales shrank year over year. And then keep an eye on U.S. Bank Corp there. The share is down here, setting up for what's going to be potentially, I think, the fifth straight day of losses. Net interest income missing estimates, despite the fact that you actually had some relatively strong numbers out of some of the larger banks a couple days ago.
Oh, totally. And it's interesting because U.S. Bank Corp, remember, they're going through a management transition. Stock is still down almost 5% on the year, even more so with this morning's move. The regionals, though, have been outperforming this earnings season relative to the big banks.
Yeah.
So this one is a bit of an outlier so far.
Yeah, and as we look at the losing streak on U.S. Bank Corp, a big winning streak for General Electric, setting up for a 7th straight day of gains. This is GE Aerospace, to be specific, up 2% on the day after raising its full year guidance. Some bullishness right now in the aviation sector. We talked about it from the airlines perspective with UAL and DAL, but also, of course, the companies making the parts doing well, too.
Fun little fact, too, with all the M&A going on.
Yeah.
GE Aerospace in that BN Spin Index is one of the best performers also.
Oh,
so
spin-off companies. Oh, yeah.
Totally. It's an event-driven stock, and we know this is a market that likes events. And speaking of them, Uber and Lucid, they're teaming up on robotaxis. Lucid is absolutely soaring this morning, Romain, up almost 45% pre-market, but they have a stock split coming as well. We're going to give you more on exactly what's going on next. Stick with us. This is Bloomberg Open Interest. And now to high interest, a look at what's making headlines around the world. Drug makers Bristol Myers Squibb and Pfizer announced that they will start selling their popular blood thinner, Equalys, directly to patients at a 40% discount. President Trump has repeatedly called on drug makers to lower prices. In May, the president signed an executive order tying U.S. drug prices to the lowest prices in other developed countries. So a little bit of movement in the stocks there, not by as much as you're seeing elsewhere. PepsiCo, we're going to talk about them too, beating estimates in the latest quarter thanks to strong international growth. The soda and snacks maker is trying to appeal to more health and budget-conscious customers. It is removing synthetic dyes from some of its products and plans to expand the use of avocado and olive oil across some brands. Pepsi now up 5.6% pre-market. And Coca-Cola. President Trump says Coca-Cola will start using cane sugar in Coke beverages sold in the United States. Currently, the company uses high fructose corn syrup, a sweetener made from corn. At the same time, shares of corn syrup maker Archer Daniels Midland are falling in the pre-market trading on that news. A lot of interesting tariff stuff going on. Romain, you might know already, Pepsi a little bit more weighted to those international inputs. People were worried about it with tariffs relative to Coca-Cola, so people are watching the pair trade.
Yeah, definitely something that could really move the market. Of course, one of the more notable decliners there, but one of the most notable gainers in the pre-market space, that belongs to Lucid. The share is up more than 40%. This after Uber said it's teaming up with the company. Self-driving tech startup Neuro to launch an autonomous fleet. Mandeep Singh joins us right now, global head of tech research over at Bloomberg Intelligence. All right, Mandeep, Uber has, of course, been trying to push into the automated game, autonomous game here. What does a partnership with Lucid, basically buying several of these Lucid vehicles, and this partnership with Neuro, what does that look like when it all comes together?
Well, they had to make a buy versus build decision. And in this case, even though it's not an outright M&A, getting a 5% stake in both companies, probably that's based on our numbers. They haven't disclosed the exact stake. But it tells you they want to develop the stack. Like Tesla has, it manufactures a vehicle, it has the self-driving software. It actually wants to have a marketplace for, the autonomous rides. In the case of Uber, even though they have partnered with Waymo in 2 cities, they haven't really got that distribution when it comes to AVs. And Neuro has specialized on the delivery side. They're not really a autonomous ride-sharing.
So Neuro's doing the software pretty much, right? And they're the ones,
Yeah.
when I see those little robot things that delivering food like through California, that's Neuro more or less, right?
And they have 1 million miles. In the case of AVs, the biggest thing that convinces the regulators you have the right technology is how many miles you have driven. They want that validation. So Waymo has done approximately 100 million miles till now. Neuro has done about 1 million miles. And look, there aren't many companies to pick from when it comes to, who can you partner with or who can you acquire. I mean, Cruise, we know they closed their operations. They tried to build autonomous technology. So a lot of the companies have given up in terms of developing technology, and Neuro is a good choice.
I also want to point out here that Lucid is looking to a 1-for-10 reverse stock split. This is really important. A lot of the big reason behind the move this morning as well in Lucid, and it raises the question for me, at least from Uber's perspective, why is it Lucid that they're the ones that are working with right now?
Well, so think about how many EV players are there, when it comes to having mass manufacturing. And even though Lucid does about 10,000 vehicles compared to, Tesla's 1.8 million units a year, so still small. Then you've got Rivian, which I think has partnered with Amazon. So from that perspective, again, you have to pick from, the options available. And in this case, Uber wanted some EV exposure. And, Lucid definitely has premium segment cars that a lot of people like, so it makes sense.
There is a question, though, about Lucid. And I know you don't necessarily cover automakers, but, this was a company that was struggling. And, I mean, you see that obviously reflected in this reverse stock split, the need for it. How reliable of a partner do you think Lucid can be in terms of delivering these vehicles, and I would presume maintaining them?
And is this exclusive?
Yeah.
Well, I mean, look, the biggest problem that Lucid has had is the manufacturing costs. Compared to Tesla, which is able to manufacture a car in $35,000, $40,000, Lucid is more, premium, almost double the cost. So now you add more sensor costs for autonomous driving, the cost of vehicle goes over $150,000. So how do you bring the overall cost of autonomous vehicles down so that you can compete with the likes of Waymo and Tesla that are also trying to bring their costs down for mass adoption? So in this case, really, the more partners are there, the more streamlined you try to do in terms of, the cost per vehicle. And then you have Uber's distribution network where all these vehicles can,
replace their driver.
That's right.
And then who am I going to talk to in the morning?
Well, I mean,
that's where I get all my stock tips for the
just in terms of numbers, Uber does about almost 10 billion rides a year. AV rides are still less than 15 million. So that's the magnitude we are talking about. I don't think you will be able to replace the, the human driver fleet anytime soon.
I like it, guys.
I have a lot of good podcasts for you, Romain. Don't worry about your morning drive in. I've got you.
Well, shout out to Julio. I seem to get him like every other morning or something. I think he just hangs out and waits for me now.
Mandeep, we thank you so very much for joining us here on set. That is Mandeep Singh of Bloomberg Intelligence. A lot going on in the technology world. Earnings season is underway, though, and so is the tariff countdown. 2 weeks until that August 1st deadline, and we're going to be joined by Mona Mahajan of Edward Jones, who's going to talk about positioning next. This is Bloomberg Open Interest.
Earnings revision breadth is explosive. And so you just can't deny that. You can't deny the fact that companies are good at mitigating tariffs, for example. Import prices really aren't up that much. So the question is, who's eating these tariffs? That's the big question I hear now from clients. It's like, well, we're collecting all these tariffs, but where are they? Some of them are on the balance sheets of companies. It hasn't flowed through the cost of goods sold yet. Some of them are from exporters. They've discounted their pricing. They're eating the tariffs. And then some of it's going to get passed on to the consumer.
Morgan Stanley's Mike Wilson on Bloomberg Surveillance. Joining us now to discuss is Edward Jones, head of investment strategy, Mona Mahajan. And the economic data has been pretty stunning. If you look at it this morning alone, retail sales holding up, pretty broadly based hold up there. You also see jobless claims coming in lower than expected. With the economy as strong as it seemingly is, do you have worries that there are perhaps tariff pressures that are still under the surface that have not shown their face yet?
Yeah, it's a great point, Sonali. And look, I think the spirit of resilience in this market has been quite remarkable. And to your point, that's underpinned by solid economic data, whether it's the inflation data that remains contained, earnings growth that looks on track to likely exceed expectations, or the retail sales this morning, which still shows a consumer that is hanging in there. Now, the uncertainty around tariffs still remains. We're all still wait-and-see mode in terms of what the tariff rates will look like, and ultimately how they show up in the economy, whether it's through inflation or lower margins for corporations. But on the other hand, we are seeing some signs that perhaps we're getting some better data around tariffs as well, or at least some loosening around tariffs. For example, NVIDIA being able to ship some chips to China now. So perhaps some of those non-tariff barriers will come down as a result of these negotiations as well. And I think that is supporting the market, certainly supporting the technology side of the trade as well.
As sort of people really do look through this idea, Mona, of where the tariff impact is, or at least where it will be, does it matter what the aggregate level is, or is it really more about this idea of uncertainty and the idea that as long as there's stability, as long as there's clarity, the numbers themselves aren't as important?
Yeah, it's a great call out. Look, American corporations are notoriously great at navigating through uncertainty and adjusting to the backdrop that they're given. So once they are given the backdrop around here are the tariff rates, here are the rules of the road, corporations can adjust. And whether that means eating some of the tariff rates, whether that means passing some to consumers, we're already seeing some of that play out. Yes, inflation has risen, but not so much, pretty modestly thus far. And yes, some margin pressures in certain sectors have shown up, but really not to the extent that everyone feared earlier this year. So to your point, I do think once we have those rules of the road set, corporations will adjust.
All right, Mona sticking with us, Mona Mahajan sticking with us here as we continue to count you down to those opening bells. Sonali, a mixed bag when it comes to futures right now. It looks like markets are going to try to open to the upside on the back of some encouraging economic data.
But losing a little steam. We'll see where we open. We are right ahead against the opening bell. Stick with us for that. And we are just moments away from the start of trading. This is Bloomberg Open Interest, and I'm Sonali Basak. We've been watching futures really lose some steam heading into this opening bell, but we are trying to get that green back on the screen with the futures up even more for the tech companies than they are for the broader S&P 500 index here. Of course, some promising news coming out of TSMC, and we'll be talking a little bit more about exactly what those stocks are doing headed into the market open. Let's take a look at the opening bells. Very interesting movement, one for the adults and one for the kids here. We have Lisa Hochstein opening the NASDAQ this morning. That's Real Housewives of Miami. She does own her own app as well. Call her a technology entrepreneur. If you are looking for a divorce, she is AI powering you. But over here, we have Bob Iger opening the New York Stock Exchange over in Disneyland. It is the 70th anniversary there. And of course, a lot of people paying attention to live events right now, as well as what you're seeing in the online streaming world that you're going to be talking about later today.
Yeah, we got Netflix earnings coming after the bell tonight, so we'll be talking about that, as well as some of the push into theme parks for Netflix, a la Walt Disney. But let's talk chip stocks. A modest bid coming into the open here, pushing NVIDIA higher, ARM higher, and quite a few other names, and that's largely because of Taiwan Semi. A big bump to start the day, up about 4%. This after the company hiked its annual outlook on strong AI demand. And all of this comes just one day after one of its key trading partners gave a somewhat dour forecast, saying it may not grow at all in 2026. So who do you listen to, Sonali, ASML or Taiwan Semi?
A lot of noise, but also some interesting movement over here in United Airlines as well. You're now seeing the stock up more than 4% at the market open. It's narrowing its profit range for the year, saying the outlook has become more predictable, but peers have been being dragged lower headed into the market open. I also want to point out, really interesting, just because we were talking about it before, Pepsi, the shares are rising in the biggest gain since April of 2020, Romaine. So fascinating earnings season.
Yeah, and absolutely. And this gets to the idea we were just talking about with Mona, the idea that everyone's looking for that tariff impact, that economic impact on these companies. And at least for right now, they seem to be finding a way to navigate.
Shrugging it off. We're going to bring now back Mona Mahajan, Edward Jones's head of investment strategy. Let's talk about earnings season, because you're looking at companies holding up better than expected. The reason Pepsi is so interesting from where we sit is because they were the ones people were relatively more worried about relative to their rival, given their international exposure. Is international exposure right now something that investors count as a bad thing, given where the dollar is and given that maybe a little diversification is working out?
Yeah, look, international had a great run for the first few months of the year. In fact, it continues to hold up pretty well. The U.S. has probably played a little bit of catch up in recent weeks, but nonetheless, it's an environment where if we still have continued dollar softness, if we are still seeing central banks globally lower rates, it's still a positive setup, but we'd say probably less so than we saw earlier this year. We think that pace of outperformance will likely ease over time, and the U.S. will play some catch up as our central bank ultimately starts to cut rates and as our earnings growth continues to accelerate. We do think this year we're looking at single-digit earnings growth for 2025, S&P 500. But as we think about next year, we could see that reacceleration, particularly as interest rates may move lower, that fiscal stimulus from the tax bill may kick in, and we see corporations adjust to that tariff environment.
And as these corporations adjust to that tariff environment, Mona, do you have any concern that maybe certain pockets of this market may not adjust? I mean, we're still early in this earnings season. A lot of the companies first out the gate, of course, are probably a little bit more insulated from that tariff impact because of their size with regards to big tech or just their complexion of the businesses with regards to the banks. But what about the consumer companies? What about the apparel companies? What happens when we get there?
Yeah, look, a lot of those non-perishable goods that we talk about, electronics, consumers, clothing, toys, all of them are thinking about strategies right now. They may have started to build inventories already. And keep in mind that inventory builds could have happened even as we were at the 10% tariff rate, and they could have built through the Christmas season already. We've heard from some companies that in July, they're already thinking about Christmas. So prices from now until year end could remain relatively contained because we did see that nice inventory build. The other call out I'll just make, of course, is a broader point on the U.S. economy. We know it's a services driven economy. 70% of GDP comes from services. And the goods, and especially those consumer goods, only make up about 11% of GDP. So even if we do see some inflationary impact, they're likely not to sway the overall basket. And even if you look at CPI, similar trends, services, shelter, rent, all moving in the right direction and make up over 60% of the basket. So it's something to keep in mind as we get through the year. We're really keeping an eye on how the services economy is doing just as much as how the goods economy is doing.
I also want to point out the role of technology in this industry, because you do have the Magnificent Seven really here posting a lot of bifurcation. You have NVIDIA just soaring this year, and Gina Martin-Adams over at Bloomberg Intelligence, her thought on this is that the Mag 7 is so last year. And she named about 27 global stocks that have better profitability, better earnings growth, and better valuations. And given what you're seeing around the push-pull with NVIDIA, China, what's happening with the Trump administration, the flipping of rhetoric so quickly, is the Mag 7 a reliable trade given NVIDIA is holding it up so much?
Yeah, I think the Mag 7 may be adjusted over time, but the fundamental theme of AI, hyperscalers, data centers has really shown up this year. And in fact, there was a lot of uncertainty heading into the beginning of this year after the tariff announcements were made, whether or not these companies would commit, reaffirm their CapEx spending plans. And in fact, all of them did across the board. And we are still seeing strong enthusiasm on not only the spending, but the potential for returns on AI. So certainly that theme has held up the market pretty well over the last several weeks as well. And we continue to see it being a secular theme over the next several years. Now, over time, we would expect the gains and the benefits in the markets to go beyond just the infrastructure players of AI, beyond the semiconductor type names, into some of those sectors that will experience the productivity gains. So think about financial services, healthcare, even infrastructure, manufacturing, robotics. All of those should benefit over time. So this theme of, yes, AI and tech should be a part of your portfolio, but keep it diversified and broad, we think still makes sense here.
I am curious, Mona, about some of the new entrants into public markets. We've seen a pickup in IPO activity. With regard to investor sentiment and their appetite for some of these new issues, and I know it'll vary depending on the types of companies coming to market, but do you think there is enough appetite and enough cash, for that matter, ready to be deployed to absorb that new issuance should that uptick continue?
Yeah, we remain hopeful that new issuance market will pick up, especially if we do continue to get this deregulation trend into the market. We think capital markets activity has been pretty subdued over the last several years, and there is this environment that was, a lot of folks beginning of the year very hopeful that we would see a meaningful pickup. We're starting to see that trend emerge. IPO activity, M&A activity, capital markets in general, we heard from the banks, is starting to show signs of life here. And we do think, if you think about, for example, over $7 trillion still in money market funds on the sidelines, there is cash that can be deployed, especially as rates move lower. Investors may start thinking about, what are our alternatives to these money market funds, and we could see that flow back into the market. So we think the setup is positive for pickup in capital markets activity here.
Mona Mahajan of Edward Jones, we thank you so very much for your time this morning. Of course, a choppy trade as we get underway in the trading day. We're going to look at the stock market right now and look at the biggest movers under the hood here. We were talking about Pepsi and just how well it's been faring. The stock is still down year to date, but it is your biggest mover on the upside this morning on the S&P 500. You're looking at Microsoft, Apple, Nvidia trying to contribute as well. Nvidia, though, has been fluctuating throughout the course of the morning. We'll see how much this sticks. On the downside, you do have Abbott Laboratories really leading your way down on the points decliners. You also have Elevance Health. Both of these are earnings stories here. Abbott lowered the top end of its full year guidance, where Elevance had cut its guidance. But big tech is mixed. Let's look at sectors here to get a better look at what's happening across industry groups, because healthcare, as we've been talking about, earnings story here, down more than 0.6%, drag a little bit on the S&P 500 here. But consumer staples, your defensive trade still back on, plus a lot of news coming out with the likes of Coca-Cola and Pepsi, industrials, utilities, consumer discretionary, all higher, financials as well. Remember, yields have really cooled down a little bit from this morning's spike off the heels of hot economic data. But you can see, of course, Romaine, those retail-friendly industries holding on strong after those economic data points have come out this morning.
All right, when we come back, we're going to dive a little bit deeper into earnings season. In fact, one of the biggest movers in the S&P right now is United Airlines, a more predictable second half. That's what the CEO says. A discussion when we come back right here on Open Interest. All right, let's get right to our top call. Some of the analyst action in focus this morning. First up, we take a look at Starbucks getting cut to underperform over at Jefferies. The analyst seeing too much froth in the stock price and says the coffee giant's complex issues, quotation marks, could take a little bit longer than expected to resolve, fractionally lower on the day. Meanwhile, to the upside is Stephen Madden getting upgraded today to a buy over at Citi. Citi saying that the company's margins are bottoming as fashion trends turn more favorable for the company's core business. Those shares having their best day since early May. And finally, CoreWeave, a new bear on the street. This over at HSBC, initiation of coverage of the cloud computing company with the reduced and the street low price target. HSBC saying the company's liquidity looks a little bit stretched. The shares down a little bit on the day. Sonali?
And let's get a check on United, because the airline had narrowed its profit range for the year, saying that the outlook has become more predictable than in the first 6 months of this year. CEO Scott Kirby spoke to Bloomberg in the last hour.
It's been a good year. I mean, it's actually pretty remarkable that we've grown earnings and margins for the first half of the year, despite everything that's happened. But a lot has happened this year. And we like to have a policy of being conservative on our guidance, because stuff does happen. And we want to be able to absorb some unexpected events in our guidance. So we intentionally build it conservatively.
Joining us now, Bloomberg Boston Bureau Chief and the writer of Industrial Strength, the newsletter. You have to catch it, of course. That is Brooks Sutherland. You know, you do still have United Airlines, even with today's jump, down about 4% this year. And I still think that speaks to how these airlines so far are saying things are getting more clear, but they're not bouncing back in this massive way. So what uncertainty is there still remaining through the remainder of this year and into 2026, where most investors are looking right now?
Sure. I mean, I think one of the things that's interesting that we've heard from both United and from Delta is there's really sort of this K-shaped recovery in the traveling public, that they are seeing a rebound in demand from that business flyer, from that premium traveler who's willing to pay up a bit more for their seats. You're not seeing the same kind of recovery at the lower end of the spectrum, the people buying those basic economy tickets. And I think that raises questions about what we might see from some of the other airlines that aren't as diversified as Delta and United in international markets markets and premium flying. And if we could continue to see pain points there that signal more of a strain on the consumer at the lower end of the income spectrum. You're also still seeing the domestic airline industry in general really struggling with too much capacity. They're all taking steps to try to rein this in, try to put more of a floor on profitability, but you are continuing to see that take a toll and some struggling in terms of being able to see that pricing power come back for these airlines.
I am curious about the disruptions that we saw earlier this year at the airport in New Jersey, Newark, New Jersey. It obviously did have an impact on the bottom line in the most recent quarter. But was there any real staying power to that? Because there was some concern that people would look at this and not necessarily blame the airport or the FAA, that they would somehow take out all of their concerns on United itself.
There was, and United would say that this is not going to stick around and that they're going to be able to move past this. I think it's a little bit too early to tell. You're right that it did take a toll in the quarter. I think there is a lot of news these days and a lot of news to keep people occupied, and that may end up working in United's favor in terms of moving on from this.
I also, Brooke, want to take a look here at General Electric. Of course, the aerospace industry right now seeing some really interesting moves, but GE has been soaring this year, up well over 55% on the year. One of the best performers when you look at the companies that have spun off from other companies. Larry Culp saying in an interview with Bloomberg, "I do think the administration is listening." And this is important, of course, because GE Aerospace was able to restart shipments of engines for a Chinese plane maker. When you think about the relationship to the administration, how important is it to a company like GE right now? And do they suffer from any future uncertainty too?
It's very important. I mean, what you've seen the Trump administration do is really upend an agreement that's held for decades, that's allowed the aerospace supply chain to operate essentially tariff-free, and he has put real kinks in that. And so you've seen, Larry Culp at GE, but a number of other aerospace executives trying to implore the administration to lift those tariffs and to understand the importance of keeping that supply chain flowing. If you look at some of the trade deals that the Trump administration has announced, Boeing airplanes tend to play a very prominent role in those deals. They are very high-value goods. They're, one of the most valuable U.S. exports. And so I think, to see that on the one end and then also see tariffs on the aerospace supply chain on the other end does create a conflict. And I think that's the message that Larry Culp is talking about. That's the message that they're trying to get across. Now, we haven't yet seen, a relief overall in terms of tariffs on the aerospace supply chain. And so I would think that this is the kind of thing that aerospace executives are very much still in conversation with the Trump administration on and trying to get a formal resolution.
All right, Brooke Sutherland, Boston Bureau Chief. How are those bike lanes coming, by the way? Have you guys finally sorted that out? Yeah.
No, it's a big battle here over the bike lanes, and you got a lot of heated interest in terms of the bike lane constructions. It's even an issue in the mayoral race, so stay tuned for that.
Yeah, don't worry. New Yorkers threw a tantrum over it as well, and then eventually they got over it. Brooke Sutherland there, of course, covers all things aerospace for us. When we come back, we're going to focus in on Netflix. They're expected to report earnings after the bell tonight, and they're expected to report record profits. But a big question about their valuations and whether a $250 billion rally has been justified. This is Bloomberg Open Interest. Welcome back to Open Interest, the second day of gains for the S&P 500 as it tries to stretch out to yet another record high, 6280 and change as we stand right now, and keep an eye on the NASDAQ 100, potentially closing out at another record high itself. Modest moves right now in the Treasury space and more pronounced moves when it comes to the dollar, and that really is the setup, quite frankly, for the broader earnings picture as we move deeper into the session. Take a look at some of the names behind me. I'm going to look over my left shoulder here for a better look here, as right now we keep an eye on big names like NVIDIA and Taiwan Semiconductor, with TSM, of course, out this morning with a relatively bullish commentary about demand holding up. CSX in play today, as is Norfolk Southern. In fact, two of the big movers on the day on the back of speculation that Union Pacific might actually be interested in buying one of its rivals. A report by Semaphore that did not name the target, but seeing big activity in CSX as well as Norfolk Southern. It's a big part of the reason, along with UAL, why you're seeing Dow transports lead the charge among the major indices and averages out there. But once we get to the closing bell later tonight, it's going to be all about what's going on in Hollywood and in the entertainment space. Netflix set to report earnings after a phenomenal run in that stock since its last earnings report. A big focus, though, Sonali, this time not on subscriber growth, but on advertising dollars and, of course, on their margins.
Yeah, looking forward to dig into Netflix right now after the run-up that we've seen. We're going to bring in now Geetha Ranganathan, media analyst for Bloomberg Intelligence. It's funny, when I talk to folks just anecdotally, they say that they don't have a whole lot of time to watch TV now. But right now, if you are watching, the slate that Netflix has had of late is pretty stellar. There's a lot of new shows out there. What does this mean for the ability to bring more subscribers on, especially at a time where the insight into subscriber growth gets a lot muddier for investors?
Yeah, absolutely, Sonali. So I think, they've had a very good slate. As you said, they've broadened their content strategy a lot. So it's not just, dramas. They have live content right now. They have unscripted content. So everything is really working. And you talk about, the first half content slate. Just wait till you get into the second half. We already kind of kicked that off with Squid Game, the final season. And then you really have what management itself kind of characterizes as an embarrassment of riches. So they have literally the three biggest shows ever in their history in this 6-month period. You had Squid Game, you're going to have 2 parts of Stranger Things, and then you're going to have Wednesday. And it's not just that, you're going to have some NFL games, you're going to have movies like Happy Gilmore, Knives Out. So it's really a monster slate, and that is absolutely going to drive subscriber growth, as well as their pricing power, so their ability to take hikes in their prices.
How far do you think they can go with those price hikes, and particularly, Geetha, on the ad tier? I understand why you would raise the price on the non-ad tier, which quite frankly still has an ad, by the way. But I am curious, for those folks who are subscribed to the ad tier, when they see that price go up to $6.99 to $7.99 and maybe even beyond that, at what point does it stop being a value proposition for the customer?
Romain, Netflix is still by far the most compelling value proposition. I think they've proven that just with kind of the breadth and the depth of the content that they offer, and they're adding more and more to this. And what really the ad tier helps them do is, be able to take up those price increases on the non-ad tier. So they increase prices by 16%. It's right now about, $18 per month. I think they still have quite a bit of runway. Just if you look at U.S. prices itself, they can take this up to $20, $25 per month. And I don't think people are going to bat an eyelid.
Okay.
I told you, the content slate's pretty good.
Yes.
Geetha, really quickly here. I mean, this is still a stock that has run up by more than 40% this year. How high is the bar for earnings? Even if they do a good job, would it be good enough given where they're trading?
Yeah, you're absolutely right, Sonali. It is kind of priced to perfection at this point, and a lot of those growth catalysts, I think, have been factored into the stock price. But really, I think when you go into the 2Q earnings report, what investors are going to be super focused on is, are they going to raise guidance? So right now, their full-year revenue guidance is for about 13% growth. If they can raise that to, let's say, even 14%, 15%, I think that's a big win. The other big number to look for, operating margin targets. 29% is the number that they've guided to for this year, but if they take that anywhere above 30%, I think, again, that's going to be a big positive catalyst. So really the focus here broadening out to the financial metrics and to the strategic direction.
Geetha, we thank you so very much for joining us today. That is Geetha Ranganathan of Bloomberg Intelligence. Looking forward to the close today.
Stranger Things. Like I remember when those kids, like, they were nice and cute and it was fun. Like, aren't they all like 40 years old now? Like,
you
what are we watching?
You can just switch to Wednesday, right?
Oh, okay.
Coming up in the next hour, we're going to get out of the entertainment zone and we're going to get into the serious business of Washington and policymaking. Rebecca Patterson is joining us next. Worried about inflation if Trump were to fire Powell. Stick with us. This is Open Interest. And we are 30 minutes into the trading day, and you see the S&P 500 lifting a little higher, about 0.25%. The NASDAQ 100 getting a little more love at 0.33%. The 10-year yield getting a little bit of relief, 2 basis points lower. Welcome to Bloomberg Open Interest. I'm Sonali Basak.
And I'm Romain Basak. Matt Miller and Katie Greifeld are off. Sonali, you're stuck with me.
I
for the
sure
next
am,
hour.
but I'm looking forward to it because we have a lot of economic data, we have a lot of earnings data, and coming up, we're going to talk about some of it. Retail sales are sizzling as Americans keep spending, Romain.
Absolutely, and we're keeping an eye on Netflix taking the spotlight as earnings season ramps up.
And Jerome Powell's fate hangs in balance. Apollo's chief economist Torsten Slok weighed in on the Fed drama.
So stagflation shock is by definition that inflation will go up and GDP growth will go down. But if you fire the Fed chair, as we saw yesterday, the dollar will likely go down. And at the same time, long rates will be going up. And the dollar going down is certainly inflationary. But rates going up is, of course, holding back growth. So firing the Fed chair will probably mainly mean a decline in the dollar and an increase in long rates.
Now, former Bridgewater chief investment strategist Rebecca Patterson agrees. She writes, quote, even if the American economy and financial markets are strong enough to moderate the impact of the Fed's tarnished reputation, the directional response seems clear. Higher long-term borrowing costs for households and businesses, and a weaker currency that would support inflation. Rebecca Patterson serves as senior fellow at the Council of Foreign Relations and joins us at the desk now. You know, you look at the rhetoric that has been coming out of Washington, the president himself, but also allies of the president, if you will. You look at Kevin Warsh just this morning as well, speaking about, yes, maybe the need for an independent Fed, but the missteps he thinks that exist at the Fed. We know he is one of the names under consideration. Now, the Treasury Secretary says this shouldn't be confusing, but is it?
It shouldn't be confusing to whom? I mean, if you're a global investor and you're trying to decide what is the right yield on the 10-year Treasury or the 30-year Treasury, the possibility that the Fed is politicized, how much risk premium, how much extra compensation should be in that yield if there is some probability that the Fed could lose a measure of independence. So I think it is confusing for a lot of investors. Is this just talk? Is nothing going to happen? Or is there a real threat here, especially because Powell could be fired if some group of senators, congressmen, et cetera, are able to make a case to the president that there's cause?
Criticism of the Fed is not new. What it does seem to be new is what is clearly a coordinated effort to try to undermine Powell's credibility, presumably in hopes that, you know, you can get him out of there before his term ends. And I do wonder if the damage might already be done. I mean, this has been, when you think about the United States of America as a place to invest, a lot of people look to our stability through the lens of really two agencies, the Fed and probably the Treasury, to a smaller extent. And now you have a coordinated effort to potentially undermine that, and I'm just a little confused as to why.
Well, I do think President Trump wants lower interest. I mean, obviously, he wants lower interest rates, but he wants them because it'll help finance the debt, which is getting bigger thanks to the big, beautiful bill. And he wants to bring manufacturing jobs back home and increase exports. And a weaker dollar that would come with lower interest rates would help do that. So there is an economic rationale here. There might be some personality rationale as well that, you know, when he wants to get rid of people who he believes serve him, and he's not able to do this one as easily. So there might be that there, but that's speculation. I do think, you know, even if President Trump gets his wish and he gets a new Fed chair at some point in the next year, even if it's without firing Chairman Powell, that person is going to have a horrible situation to come into because their credibility is going to be immediately questioned.
Why not just keep quiet? We're talking 10 months from now. I mean, you could have just kept quiet for 8 or 9 months, put your nominee out there, not said a thing, and the perception would have been so much different than what we're going into right now.
Well, I mean, is he trying to protect himself from potentially different economic conditions moving forward so he could blame the Fed?
That's possible. Yeah, that's possible. But to your point, I think you're 100% right. There is going to be a seat opening up in January. And so the president can nominate who goes in that seat, and the Senate presumably would support that person. And so that person could be elevated to chair next May when Powell's chairmanship ends. So they have the ability to make that move now.
When you look at the contenders, at least the ones that the media seems to be reporting on, Kevin Warsh, Kevin Hassett, I guess Waller to a certain extent, and I think Scott Besson's name has even been thrown in there. Who would you want to see amongst that slate?
I mean, they're all experienced. They're all incredibly bright people.
Yeah.
Again, that's the challenge. Even if I think eminently qualified, now I'm going to be wondering, are they making this decision or pushing for a decision? Again, you need a majority vote within the FOMC. Are they doing it for the right reason?
Does it matter that some of those people I named seem to be actively campaigning for the job publicly?
Well, it just means that financial markets or investors are parsing those comments to try to gauge what they would be like if they were chair, to see what kind of steps could we expect. So Kevin Warsh on another program this morning talking about a new Fed Treasury Accord. The last one was created in 1951 to give the Fed more independence. So if we want a new accord, what does he mean with that? Or if the Fed's independent, but we need to be focusing on borrowing costs, does that affect QE, QT? Like, where are we going with this? And I think now that you have people very vocal about their desire to help drive the Fed forward, we're going to be parsing every single thing they say, and that's going to influence markets, and it could create more volatility.
We're showing here poly market odds as well, which I find have been very interesting, and more traders following them kind of closely here. But I do want to talk about real world implication also, because you do see the economic data still coming in strong. You see Bitcoin hitting 120,000. You see SPACs flying into the stock market once again. Is there a justification to start cutting rates this year, given where the economy is, even just on the data we're seeing right now alone?
Yeah, so there are signs, lots of signs, that the economy is moderating. Despite the strong retail sales we had this week and slightly better guidance from some of the earnings we've gotten out from the banks especially, saying the consumer's okay. But if you look at the latest beige book that the Fed produced yesterday, it was showing almost every district seeing a moderation in growth, more pessimism about the outlook, and importantly, rising prices. So if I'm sitting at the Fed and I know August 1st, there's the potential for tariffs to go significantly higher. I know from surveys of CFOs that they're planning to raise prices. They're saying we're going to raise prices in the coming months, but growth is moderating, but from a good place. I'm not cutting rates. And yes, the Fed cut rates last year, and they're not cutting this year because we're in a totally different place. And last year, real interest rates were significantly more restrictive than where they are today. So they were trying to get a little less restrictive last year. They don't need to as much now. Rates are absolutely lower.
So in your view, there's not really an economy to be saved right now in terms of coming to the rescue. I guess the question, though, too, is, and if you look at the administration's argument, the idea is that they do want to see more stimulus for this economy, whether it's from fiscal policy or monetary policy. Is there a case to be made for some degree of a bump, not so much just for the short term, but the idea of keeping things going, and maybe you lay the groundwork for that with, I don't know, 25 basis points, 50 basis points of cuts?
So if inflation could come down further, right? Headline CPI, which I know isn't the gauge, but it was 2.7 this last month. So it's still quite a bit above where we want to see it, for even for core PCE, for the Fed's preferred gauge. If inflation kept coming down, even though growth was strong, the Fed might want to take a little more interest rates off the table just to get less restrictive and try to engineer that beautiful Goldilocks. But we need to see inflation come down, or we need to see the labor market worsen, and it might, but it hasn't yet. So I think right now it makes sense for the Fed to be sitting on his hands. Is there a risk they're late? Yeah, there is, but it's a lot easier to do a couple quick rate cuts than to have to cut and then raise rates again.
That's a good question. Is it better to be late or is it better to be early?
Well, it's better to be perfect, but if
you sound like my mother.
If you're cutting late, you know, where they are right now, they can cut they can do 50, they could do 75 basis points. So they could catch up and send a signal to the market pretty effectively from here if they needed to.
Rebecca, I think a lot of the reason investors are watching this tit for tat so closely is the Federal Reserve has played this massive role in a few ways. Yes, of course, interest rate setting, but also that idea of a Fed put, the kind of role that the Fed has in saving the market if things go awry. So if you have to prepare yourself for what the Trump administration's influence is going to be on the Fed moving forward after a new chair exists post Jerome Powell's term, what is the implication to the market itself?
That's my next op-ed. That's a great question. It's a great topic. I mean, on one hand, again, it's a majority vote at the Fed. So even if you have 2 or 3 or 4 members of the FOMC, the voting committee, who agree with the president, it doesn't necessarily mean you're going to get what you want in terms of a put. At the same time, I think you could take it the other way. So if we're politicizing tariffs in new ways that we never used them before, for Brazil politics, for gosh sakes, what's to say we couldn't politicize Fed swap lines? If a country wants our help in a crisis, and the Fed historically has provided dollar liquidity, could we now do that just for countries that pay their fair share? I mean, so I think politicizing the Fed could have a number of different real-world implications, back to your comment, that we haven't even processed yet.
Yeah, this is amazing. And your last column, by the way, thanks for helping her with her next column, but your last one, that 35% we're talking about, I know you drew a lot of parallels to Hungary and Turkey. We're not headed down that road.
No, of course not. America is still exceptional in so many ways. I was just trying to show parallels where governments eroded central bank independence and the impacts they had. In every single case, it was higher long-term borrowing costs, even though you had shorter rates lower and much weaker currencies. And I think in the United States, even if the degree would be much, much smaller, I think the direction would probably be the same. And we've seen it as well. It's not just emerging markets. We've seen that in Japan. We've seen that in the UK and within the US in the 70s. So we have enough examples that we know what we're asking for here.
Yeah, absolutely. And it's a great column. I definitely expect everyone to check it out. Rebecca Patterson there over at the Council of Foreign Relations, formerly at Bridgewater, as we keep the show moving with a closer look at some of the big stocks moving this hour. That includes TSMC. TSM, the ticker, a boost in its sales growth forecast as AI orders, at least for now, seeing no signs of a slowdown. UAL, United Airlines, getting a pretty modest bid on the day after it narrowed its profit range. The initial reaction was to the downside, but the CEO speaking with Bloomberg just a while ago saying that the airlines might actually be excluded from tariffs, and that gave a nice pop to the stock. And PepsiCo, that is your main leader in the S&P 500 right now, thanks to strong international demand.
Interesting. Still, though, down almost 5% on the year. Let's see if it gets flat. Let's see if it plays that Coca-Cola catch-up.
Are you a Pepsi or a Coke person?
Neither.
Or do you not care? Okay.
Neither. I don't do soda. Come on.
Oh, okay. Excuse me.
But too much coffee.
Are you like one of these, you and Tim Senate, like two healthiest people in this building?
Yes. And also interesting, coming up next, we're going to talk about another big mover in the market, Lucid just soaring, looking at a reverse stock split and pairing up with Uber on Robotaxis. We're going to bring you more on that story next. This is Bloomberg Open Interest. And now to high interest, a look at what's making headlines around the world. Shoppers snap back. U.S. retail sales rebounding in June after the White House dialed back high tariffs. Consumers appeared to temporarily shrug off trade wars, and they've spent more on cars, on clothes, on dining and do-it-yourself projects. The report offers some relief around mounting anxiety around the health of the U.S. consumer. And President Trump said that he would send letters to more than 150 countries, notifying them that their tariff rates could be 10 or 15% as he forges ahead with his trade agenda. In recent days, Trump has unleashed a barrage of tariff demands, informing other economies of new duties that would kick in on August 1st if they cannot negotiate better terms with the United States. And Union Pacific is reportedly working with investment bankers at Morgan Stanley to explore an acquisition of an unknown rival. The Union Pacific CEO is on record saying that a transcontinental railroad merger would fuel growth and improve service, but neither Morgan Stanley nor Union Pacific are commenting. Romain, this is a market that is in love of a story around M&A.
Absolutely here, and well, not quite M&A, but the story that the market's in love with this morning involves Lucid. The share is up about 30% after we learned that Uber is actually teaming up with the EV maker and the self-driving tech startup Nuro to launch a robotaxi fleet. Ed Ludlow joins us right now, the co-host of Bloomberg Tech. And Ed, I guess it's not surprising. We know Uber has made a lot of moves in this space with regards to autonomous driving. But talk about the difference in what this type of deal with Lucid and Nuro compared to maybe the types of deals that it already has with Waymo and Volkswagen.
Great question. It's in line with Uber's broader strategy, but it's a three-way deal. Lucid provides the vehicles, Nuro provides the software, Uber basically finances and pays for everything. It puts $300 million into Lucid so that they can update and retool the assembly line to build vehicles, Lucid Gravities, that accommodate autonomous hardware. Nuro integrates its tech in Lucid's facilities. Starting in 2026, separate from that investment, Uber buys a minimum of 20,000 Lucid Gravity SUVs. So that is completely independent. It's actually, noting the move in Lucid shares, really interesting revenue, guaranteed revenue for them. So at the end of 2026, when they start production, over a period of 6 years, Uber takes delivery of a minimum of 20,000 of these specially retrofitted Gravities, and then operates the robotaxis on its platform in the same way that Uber operates Waymos on its platform, but doesn't have any responsibility for the manufacturing or capital expenditure of the vehicle itself. This is slightly different because Uber's buying those vehicles directly from Lucid.
How important is this at Uber? You're not seeing, of course, you were seeing a very significant year-to-date appreciation of its stock, but today they're not biting as much. Why is that?
Well, because if you do some basic maths, we don't know what the per unit price of a Gravity will be, but let's say it's $75,000 and they've committed to buy 20,000 of them. That's $1.5 billion of purchases they've got to make right there. And it's a minimum commitment. So it's expensive for Uber, even though it's kind of not taking on the burden of manufacturing the vehicle itself. It's not an OEM. Also, Uber's kind of spreading its strategy pretty wide, right? It has a number of partnerships in a number of jurisdictions on robotaxi, almost hedging its bets a number of years after it gave up on its own sort of pure play robotaxi strategy. So that's kind of interesting. It's not full stack. You compare with Zoox or Tesla, where they own the technology, they manufacture the vehicles, they own the software, and then they operate the robotaxis through proprietary ride-hailing. Uber just operates the robotaxis through ride-hailing. It doesn't take on the other burdens of the tech stack and the manufacturing of the vehicles. So it's interesting.
Hey, Ed, I want to get your thoughts here on another aspect that's going on in the tech industry today, and that involves chip stocks. You're taking a look at TSMC. Right. It's a market cap crossing the $1 trillion threshold, a relatively bullish report and guidance, and it seems to sort of ratify this idea that AI spend that, of course, everybody's been obsessing about and everybody's worried would slow down, at least for right now, it's not.
It's intact. Like, the majority of TSMC revenue is GPUs or AI accelerator cards that go into data centers of training AI, proportionately so far ahead of smartphones, which is TSMC's legacy. They've maintained this capital expenditures guidance, which gives the market a lot of confidence. Super interesting, and maybe this is a bit sort of in the weeds, but FX is a really important factor here. TSMC is like this global giant, but it's also the crown jewel of Taiwan. It books its revenue in dollars, but its operating expenses are all in Taiwanese dollars. And what it warned us was like, actually, that's going to hurt us. Margins were super impressive in the period gone, beat expectations, but later in the year, when you take into account that currency headwind, margins will be impacted. Find that so fascinating, a company that's like so entrenched in Taiwan, but as you guys know, investing heavily in the United States as well to build out its facilities here and bring capacity onshore to the US.
Ed, when it comes to the earnings season for the big tech giants, I want to talk about Netflix a little bit because, of course, it's not a Magnificent Seven stock. It has just been soaring this year. Ahead of earnings, you see the stock up another 0.6%. What are the expectations? There's been a question of can it keep this run up? But you look at the content slate, and it seems like people are willing to pay for the goods.
So shameless plug here, and I'm looking down at my screen because I just sent my team the scripts for our show and tried to pack as many puns into the Netflix preview as possible. The reason being is we won't have that subscriber growth metric, right, or subscriber count. Netflix has always said, look at us as a traditional company the way that Wall Street should do, top and bottom line, and other metrics, net income being one. But you also need to look at some of the mechanisms they have. If they won't tell us the number of subscribers that they have or how it's growing, what are they doing to boost the top and bottom line? And price hikes is a really key feature for Netflix in various jurisdictions. The FX consideration is important here. But as I joked with Romain earlier, like, I'm just all about Squid Game right now. I just finished the 3rd season last night. So the content slate for the second half is so important. Like, it matters. Do they have some cool stuff to watch? What do their peers in streaming have to watch in the second half of this year? Believe it or not, when I get done in this place, I go home, I have like an hour or so to stream and watch TV. Netflix has some competitive offerings.
You're not watching Mr. Robot? Even some of the older shows are pretty good to return to right now, Ed.
No, I'm all about Squid Game, and then if I'm lucky, I just started watching. Yeah, I'm all about Squid Game.
I love this. You know, Ed's a new father, so in a few, about a year's time, your viewing habits are going to change in a pretty tremendous way, Ed Lolo. So
enjoy it while you can.
I hope you like silly little songs and dancing around.
Baby Shark.
That's all you're going to be listening to for the next 5 or 6 years.
And Bloomberg Tech co-host Ed Ludlow, we're looking forward to breaking it all down for us. And still ahead, it's still early days for Netflix's ad business, giving it multiple levers to create value as the media landscape evolves. We're going to discuss this with the CEO of e-commerce analytics firm MikMak. Stick with us for Rachel Tipograph next. This is Bloomberg Open Interest.
The S&P 500 opening at a record high on the day, but giving back some of those gains as we start to get deeper into the session. A big lift today from NVIDIA, Microsoft, some of the big tech names, as well as from some of the big consumer companies as well. That includes a big move higher, up 6% for Pepsi here on the day. A drag in other spots of this market, but when you take a look at the GRR screen and you look at the 11 individual sectors, 5 of them leading the charge right now. But again, a big weighting right now to consumer staples, a big weighting to industrials right now, maybe on the back of some of the big bump that we're getting from UAL and some of the other spaces in the travel space. Sonali.
Very interesting mixed earnings season coming up, but a lot of signs that are promising too, especially from the economic data. Retail sales surging as consumers spend more dough on dining out, or at least rising more than Wall Street had expected. We're going to talk consumer appetite with OpenTable CEO Debby Soo next. Stick with us for that conversation. This is Bloomberg Open Interest. Now, U.S. retail sales rebounded in June despite anxiety over tariffs and the state of the economy. Consumers spent more on cars, clothes, and dining. Let's get a read on the consumer with OpenTable CEO Debby Soo. OpenTable helps to fill reservations for more than 60,000 restaurants, bars, wineries, and other venues worldwide. Debby, you look at the data, and I'm wondering what your data actually says. What are the types of consumers that are able to withstand the pressure of this economy to the extent that pressure exists?
Yeah, so we're seeing, even with the economic uncertainty on the macro level, that people continue to go out and dine. They prioritize their discretionary income on dining out. And we're seeing it all across all price points on our install base. And we're actually even seeing for the $50 per person and up, that's growing year over year. So despite all the news out there and the pressure we all may be feeling, people continue to want to go out to restaurants, have a good time, enjoy good food. And I think people who are watching, and even for you two, you go out, restaurants are largely full and busy, which is great.
Yeah, well, especially in this city.
Yes.
Do you see geographic differences, though?
Oh, for sure.
Yeah.
I mean, New York, as you alluded to, is historically very slow. Like, everyone somehow just escapes the city in the summer. But actually, even this summer, we're seeing New York is actually up 8% year over year in June, which is great to see. And we hear it from some restaurateurs here, too, where it's like, we continue to, it's up. Which is great to see. But we also have other cities like Houston, Chicago up double digits. Chicago's up, San Francisco's up 9 digits. So we're seeing that, I don't have a crystal ball and I hope it holds, but it's wonderful to see this flurry of dining activity happening through the summer.
As you start to see this activity, I mean, how much information do you collect? So if I go through your site and I make a reservation for a restaurant, how much of that data about me, about my dining experience do you get, and how do you leverage that to build up the business?
We really get whatever you decide to give us, right? So if you want us to know your birthday and your allergies and your anniversary, and you want us to pass that through all the restaurants you dine with.
My birthday's on Sunday, by the way.
Oh my goodness, happy birthday.
Thank you.
Do you want me to put it in OpenTable?
Well, I'm just letting Sonali know. So,
he has the best. I can't keep up with your restaurant. He's much cooler than me.
Wait, do you know where you're going?
My wife has a big surprise for me.
Oh my goodness. Okay, well.
That I've already figured out.
Have her text me if you know. But anyways, so if you as a diner want to share that data, we will share that wealth of data for the restaurants, because restaurants love that data, because they can provide a great hospitality moment when you come in on Sunday. Happy birthday, Romaine.
Yeah.
They know what you love to eat. They know what your allergies are. But it really is up to the diner how much you want to share. But once you do share it and give us permission, we try to arm restaurants with that information so they can provide amazing hospitality to their guests.
Okay, if I'm not mistaken here, all the New Yorkers that are leaving might be going to the Hamptons, and I think that they're paying for maybe what is going to be soon a $100 lobster salad at Doria's. And so, you know, it's amazing because what we're talking about here is a worry about also a K-shaped kind of recovery here in this economy. But even on kind of the lower income side of things, it's interesting you're seeing casual dining still outperforming quick service. Why is that?
Yeah, I think after the pandemic, when restaurants were largely closed for a period of time, we missed it. People go to restaurants to get a good meal, whether that be at the lower price point or the higher price point. You go there to get taken care of. You go there so you don't have to cook at home and shake up the week a little bit more. So I think again, even wherever you land on the spectrum of income, you still want that experience, right? And so you prioritize that spend when you look at your household budget, which is great to see. And we love that for restaurants because, as you know, and I've come on and talking about it, it's a really rough business. It's hard running a restaurant. They run on laser-thin profit margins, and then with all the labor shortages, supply chain issues, inflation, and there's nothing more expensive than an empty seat. So as much as OpenTable can be helping diners discover restaurants, fill restaurants, make them more productive. That's what we're here to do.
You want to know how hard it is to run a restaurant? We're talking about content today.
Yeah.
We're watching the latest season of The Bear.
Okay. Absolutely. I mean, and it gets to this idea though too that, when we talk about that data, when we talk about the restaurant experience, I know you guys have deployed some AI tools. We were talking during the commercial break about the partnership you have with regards to the Chase Sapphire card and potentially having people get points, which I would assume would maybe engender more loyalty not only to OpenTable, but maybe even potentially for the restaurants themselves.
Correct. Yeah, we've been on a flurry of activity at OpenTable. So we this week launched Concierge, which is an AI-powered search bot. So if you land on a restaurant profile page and you want to know, are there gluten-free options? Is it kid-friendly? Can my dog come? There are a variety of different questions, and the chatbot will give you the response. So far, engagement is great, and the answerability.
And the chatbot won't get upset with me because usually when I go out, it's like 6 people and everyone has there's like 6 different dietary restrictions.
Yeah, but you could put all of that in. My mom doesn't like shrimp, but she likes lobster. And whatever it is. So we launched that. That's really exciting because we know that people spend so much time, on average 20 minutes, to learn and discover a restaurant before they decide to book, right? So we're trying to help make that a lot easier. As you mentioned, we're doing a lot of partnerships. We recently just announced a partnership with Chase. They have done a relaunch of their Chase Sapphire Reserve card. OpenTable is part of that. So if you dine at an OpenTable restaurant that is within the Chase Sapphire program.
Is that going to help me get into the hard, because in New York, I mean, you want to go to Tatiana, Teresi or something, basically I have to tell them I'm Tom Keene to get in the door. That's the only way they even take my.
It will help you get in. If you have the Chase Sapphire Reserve, there will be primetime inventory that is reserved just for you, Romaine. Right, so at places like Don Angie or San Sabino, right, you'll get access to some time slots that people who do not have the card get access to. And you also get statement credits. There's a whole host of benefits.
When JP Morgan hiked the fee of this Sapphire Reserve card, $795, it made it one of the most controversial moves actually in the industry. You're paying more, but you should be getting more, and OpenTable is a big part of that, right?
Correct.
What are these credit card competitions really doing to the industry, and are they giving more and more back to the consumer in a way that makes it easier for them to ultimately dine? How do you quantify the impact?
I think the benefit to the consumer is clear, right? You pay a fee and you get statement credits or access to things that you wouldn't normally get. But from where I sit, I actually think the benefit to the restaurant is cooler, right? As we said, it's tough running a restaurant. And so as much as we can be funneling resources and money back to them, right? A lot of these credit card companies are paying top restaurants for the privilege of access during prime time. And that money is going straight into restaurateurs' pockets. So that's actually what I really love about these types of partnerships. It's great for the consumer, but one could argue that the consumer who's willing to pay $800 for a credit card is going to be in decent shape. What I love about it is that it's like diverting or funneling more into restaurateurs' pockets.
And obviously they need all the help that they can
That's
get,
right.
even the high-end ones. Debbie, always a great conversation.
Thank you.
Great to have you. OpenTable CEO Debby Soo there. Sonali, I know, I mean, your name opens doors, right? Can I just drop your name next time I'm trying to get into one of these places?
I'll let you know.
All right. Wow. All right, let's check in on the markets here. The stocks pretty much holding their gains from where we started the day, at least on the broader indices there. You take a look at some of the individual movers, Sonali, and of course, I'm really focused right now on Netflix. That they're going to report after the bell on my show. You know I have a show too, right?
Yes, I'm looking forward to you breaking it down later.
Are you going to stick around for that too? We can go wire to wire.
I'll be watching from somewhere else, maybe a fancy restaurant. Anyways, U.S. Bancorp down. We were watching financials still this earnings season. The banks have been running up, but they have missed on net interest income estimates in the first report under a new CEO. And we've been watching this as well. Archer Daniel Midland, I think this is a really interesting ripple effect of Coca-Cola's decision to use real cane sugar, they say, instead of the sugar that is more tied to corn syrup, which Archer Daniels is behind.
Yeah, and there's some great history with ADM and the whole move to high fructose corn syrups back in the 70s and 80s that I don't think we have enough time in this show, but if I were Matt Miller, I would just keep going and blow the break.
You know, Romaine is also on the close, so we can get into it more then as well.
All right, and of course, we will have full coverage of those Netflix earnings after the bell tonight, but meanwhile, open interest continues with a closer look at what those earnings might look like, a conversation with e-commerce analytics firm MikMak on what they're seeing with regards to a surge in clients willing to work with Netflix. That's coming up next here on Open Interest. This is Bloomberg.
And when we look to Netflix reporting after the bell, we're going to be talking a little bit about advertising revenue to see how much exactly they could squeeze out of that pie. An e-commerce analytics platform, MikMak, works with 2,500 customer product advertisers, and CEO Rachel Tipograph says that her customers didn't advertise on Netflix until 2024, 2 years after it got into the ad business. MikMak CEO Rachel Tipograph joins us now at the desk. This is an interesting question for Netflix, especially as it gets further and further into live entertainment as well. What's the potential for them to get much bigger in the space?
The potential's massive because it's honestly really small today. When you think about Netflix and the opportunity to advertise in CTV, there's been more established players. You have Hulu, you have Peacock, you have HBO Max, the list goes on and on. And so beyond that, you also then have the DSP side, Trade Desk, Amazon, Microsoft Xandr. The space is actually highly competitive and really established. So the only place for Netflix from this moment in time is to go up.
What does engagement, though, look like when we talk about advertising on a platform like a Netflix or really any streaming platform relative to maybe advertising on social media, where the way that people interact with not just the ads but the posts themselves is just a little bit different?
Yeah, it's early days in interactivity in CTV. If you're going to look at anyone and say they figured it out, it will be Amazon. And it's because Amazon not only owns the demand side, and now they have a content play, but they also own commerce. So you have the opportunity in that environment to truly have full funnel marketing from inspiration all the way down to conversion. When you look at the rest of the CTV players, the user experience overall is still kind of clunky when it comes to interactivity. It's either QR code or using the remote or maybe even the mobile app from a second screening standpoint. Netflix, again, it's early days when it comes to interactivity, but they are making investments even beyond CTV advertising in an environment like gaming.
You know, my family, while we're watching streaming services these days, get really frustrating because you're paying for the streaming services and now you're getting the ads anyways. Is this going to be more and more of a reality for Netflix viewers years down the road?
Absolutely. I think we all know this. The reason why Netflix started to get into the advertising game is that they capped out on subscriptions. And they're now not even reporting that as a metric, right? They're looking at revenue per user. So every single user, how are you going to monetize them? The easiest and most profitable way is through advertising. if you think about the opportunity, depending on what you want to think about as the overall space, you could look at online video, you could look at CTV, you could look at programmatic video, you could look at social video, you could look at linear TV. If you size all of that up, it's a $250 billion TAM.
So if you're an advertiser, would you rather advertise on Netflix or on YouTube?
Very different questions. YouTube, you have more reach, you have more targeting capabilities, you have real-time optimizations, you have measurement. Netflix right now, I would say if you were to compare them to YouTube, they have premium content assets. So if you're a brand that wants to be associated with those premium content assets, great audience. They also have certain rights when it comes to live streaming, when it comes to events, but so does YouTube. I think if you're a brand that's really conscious about every dollar and making it work the hardest, the Netflix CPM is more expensive than the YouTube CPM because there's just more YouTube inventory available.
Do you have any insight, though, into how much information Netflix is sharing with advertisers with regards to what we're watching, how long we're watching it? Because they've been pretty stingy with that data, at least making it public to investors. I mean, we kind of have a general sense, but it's very surface level.
Yeah, I think it's early days with Netflix in terms of building out their ad platform capabilities. In order for advertising to scale, they're going to have a self-serve ad buying platform that can optimize in real time and can report on analytics in real time. That's something that they've been public about, that they're focused on building out. And once they build that out, I'm sure we'll start to see additional scale, but that's really required to compete in today's market.
There are a lot of people that have questioned whether they have the true capabilities to do that. I mean, we know they have the deep pockets, but there's an expertise there, and that's not something you just flip a switch and somehow you magically figured it all out.
Yes and no. You go through an assessment, build, buy, partner. Initially, their entry was to partner with someone like Microsoft to help them accelerate in advertising. I mean, Microsoft is one of the 5 biggest players in advertising. Over time, they might choose to let go of that relationship because they'll have time to build out the assets themselves. But if they want to make a big splash really quickly, partnership is truly the angle right now.
I want to talk also about the food chain here when it comes to these big content distributors versus the advertising community and a big middleman. Trade Desk, set to join the S&P 500, but there are members of the analyst community who look at this relationship and ask how much it could hold up. Yes, they're a massive player in this game, but is there a chance that those content companies can get more and more leverage over Trade Desk?
Yeah, I think the question is, does Netflix want to own the pipes? Amazon decided that they want to own the pipes. They have a DSP. Trade Desk is a DSP. Microsoft Xandr is a DSP. The opportunity to scale your business beyond the assets that you have to monetize is in the DSP space. So right now, Netflix is still just figuring things out. Over time, they might actually say, we want a DSP. And if they do that, then they would become a competitor to the Trade Desk. But if Netflix is trying to get ad dollars right now, the path of least resistance is to partner with someone who is a DSP like the Trade Desk.
So how long do you see this time horizon playing out to the extent that they create a rift amongst each other? When does that actually happen? Is it 5 years down the road? Is it 10 years? Is it sooner?
I mean, the speed of innovation right now is faster than ever before, right? We are living in Moore's Law. So if I'm Netflix, like, you got to figure this out in the next 12 months if you want to capitalize on this opportunity.
All right, Rachel, great conversation. Great to meet you. MikMak founder and CEO Rachel Tipograph. A look at the ad tech business maybe that Netflix is building out. And just a reminder, full coverage of Netflix's earnings report after the bell tonight on The Close. Meanwhile, open interest continues to roll on with a closer look at President Trump denying plans to fire Fed Chair Jerome Powell as he ramps up the campaign against him. We're going to get the latest from Washington when we come back after the break. This is Bloomberg. The pressure on Fed Chair Jerome Powell to cut rates or step aside, that continues. The President of the United States saying he's not planning to fire Powell, but did add he, quote, wouldn't rule anything out. Joining us right now is the co-host of Bloomberg's Balance of Power, Kayleigh Lines, talk a little bit more about this. And Kayleigh, we should just be very clear here. This is more than just the president. It's Bill Pulte, it's Kevin Warsh, it's Kevin Hassett. It's a whole host of names that seem to be making a case that Powell should maybe I don't know, leave before his 10 years up? Is there any sort of sense here that when Trump says he's not planning to fire Powell, he has no idea where all these reports are coming from? Is there some reason we should believe that?
Well, the president also didn't entirely rule out that Powell could still be forced out of the job, Romaine. When he spoke with reporters in the Oval Office yesterday, he said it's highly unlikely that he will fire Powell, but that he still sees a possibility he will have to go for, quote, fraud, as officials in the administration are alleging that there may be fraud around the renovations to the Federal Reserve buildings here in Washington. That is the narrative that is being, of course, propagated extensively by the FAA director, Bill Pulte, who you just mentioned. We spoke with him on Balance of Power last night, and he is adamant that the Fed chair should resign, and told us repeatedly that he's hearing that Powell is considering resigning, though he wouldn't say exactly where he's heard that, but that is coming word of mouth from people, including from inside the Federal Reserve. He also told us that he's confident Congress is going to open an investigation into the refurbishments of the Federal Reserve building and whether or not Powell was deceptive in his answers to Congress in testimony earlier this year. So by no means is this story over, and by no means is the president signaling he's going to stop putting pressure on the Fed chairman to lower rates. He was at it once again on True Social in the aftermath of today's strong retail sales data, saying too late. Look at the data, lower the rate, essentially, to paraphrase what the president posted. But when we consider this fraud question, Romaine and Sonali, it really is a matter of whether or not the administration may be searching for cause here, knowing that legally there are protections for the Federal Reserve and specifically for Fed governors who can only be removed by law for cause. So this may be an effort to drum up cause here, but it still could result in a massive court battle if and when the president were to decide that while he's not planning on it for now, he does ultimately want to fire the Fed chair.
How much is the president paying attention to the bond market as the Treasury Secretary is? Because you have, for example, TD Securities calling the removal of Powell as a low probability but a high impact event. And they say that in that event, they would expect investors to price in higher longer run inflation, higher term premium, more near-term Fed rate cuts, hence lowered front-end rates, but increased market volatility and a steeper yield curve, so perhaps higher long-end rates. And it's that 10-year that the Treasury Secretary is watching. What do you make of this concept that the president is floating some trial balloons here?
Well, Sonali, we know that President Trump has paid close attention to the bond market in the past, including when we saw those incredible gyrations in the aftermath of Liberation Day back in April, which he noted as queasiness in the bond market and helped spur his decision to offer a delay in those tariffs actually being implemented, which, of course, we have since seen delayed again. But to your point on how this actually could result in rates being higher at the long end, it is counterintuitive to what the administration is trying to achieve. What Scott Bessent has said, what President Trump has said, is that they want borrowing costs to come down, including to finance the interest on the debt here in the United States, but also for things like mortgage rates that are heavily felt by the American people. And it could have an adverse effect if you were to see disruptions in the independence of the Federal Reserve sending long-end rates higher. They're not necessarily going to get the lower borrowing costs that they want. So it's unclear whether or not there are voices in the president's ear, like Scott Bessent or others in his economic circle, that are signaling that to the president, and whether that factored into the president pushing back against reports that he was considering firing the Fed chair yesterday. But we know that this president has a long history of paying attention to financial markets.
Kayleigh, we thank you so very much for your time this morning. Catch Kayleigh on Balance of Power at 1 p.m. Eastern, then again at 5 p.m. Of course, the story changes a lot in the course of a day. And speaking of today, let's just get a check on these markets, how they're faring. The S&P 500 still up about 0.3%. We're below that 6,300 level that we hit a little earlier in the week, Romaine. The NASDAQ 100 flying about 0.5%.
Yeah.
We spoke to Stuart Kaiser at Citigroup a little earlier this week. He was saying that clients are starting to call him on the days where you're seeing 0.5% move.
Yeah.
So that's how sensitive this market is to upward pressure, if you
Very
will.
sensitive, and that bit of that grind higher, and maybe that changes tonight. Obviously, Netflix, a big component in the NASDAQ, so we'll see what happens after they report later this evening.
And coming up tomorrow, Monetta's Chief Global Market Strategist and EFIT David, plus Lori Heinel, Global Chief Investment Officer at State Street Investment Management. Stick with us through the close. This is Bloomberg Open Interest.